So it's been a bit of a rocky start of the second half year in financial markets. Future volatility expected by market participants spiked up to levels not seen since 2020. Now, with some historical perspective, this is not that unusual. It is normal for markets to have periods of falling prices and volatility. And we're seeing more and more signs of calm and recovery, so I wouldn't really have made a video about this if it wasn't for Japan. The Nikkei, which is the most quoted benchmark for Japanese stocks, had its second worst day on August 5th, worse than any day during the financial crisis. Japanese banks saw their largest daily drop ever, down between 15 and 20% in one single day. Now, it's one thing having a more speculative tech company move like that, but it's more noteworthy when it happens to a bank whose day-to-day operations look like this. Why did the Japanese market fall so much more than the rest of the developed market? The answer seems to be a combination of two things: crowded trades and leverage. And it involves, among other things, the Japanese yen carry trade, that we will go more into details with examples using actual data. And the takeaways from these past events, I would say, are almost timeless. So even if you feel that the fall in markets we saw at the beginning of this month were ages ago, I would still recommend you to stick around. But first, what could explain the market downturn we saw outside of Japan? In the US, we saw some economic data, most noticeable a US jobs report that came in below expectation. Analysts and commentators saw this as a sign of US economic growth slowing down, or worse, that a recession is coming. On top of that, we saw some sell-off after disappointing earnings reports from some large tech companies. Now, in Japan, the second worst day for the Nikkei was August 5th. This was the first day that the Japanese market could react to the US jobs numbers. But why was the reaction so much worse than other markets around the world? For some context, let's first start with some of the differences between Japan and the US in terms of interest rates. In contrast to much of the rest of the world, the Japanese central bank has been fighting periods of deflation, that is a broad decrease in the price of goods and services, compared to fighting inflation, which is increases in prices. The BOJ has been doing this by keeping rates at or below zero since 2010. So compared to other rich world countries, especially the US, interest rates in Japan are very low. So this has made it quite lucrative to borrow cheaply in Japanese yen, convert the yen into a different currency, and invest the proceeds in an asset that has a high return outside of Japan. And this is the so-called Japanese yen carry trade. So let's look at an example how this would work at the start of the year. Let's say we want to put 100,000 US dollars in US treasuries. At the start of the year, you could get around 140 Japanese yen for $1 US. So starting with 14 million Japanese yen, we convert that yen amount, that gives us 100,000 US dollars. We then put these dollars into US treasuries, earning at the time around 4% per year. After a year, we convert back our US dollar amount into Japanese yen. So assuming that the currency rate stays the same, the return or carry of this transaction is 4%. Now assume that we did not put all 14 million Japanese yen up front with our own money, but instead we borrowed, paying an interest around 0%. Just like when you borrow money to buy a house, you have to put up some of your own cash. And in this context, this is called margin. As an example, assume the margin requirement is 5%. So to finance a 100,000 US dollar position in US treasuries, we would only need to put up 700,000 Japanese yen. Now, with just a fraction of the total size, we can gain a sizable profit. With leverage, we could earn a higher return, basically amplifying the carry we could achieve. In this case, if the currency stays the same, our return or carry would be 80% instead of 4%, still assuming our financing cost is 0%. Now, if the US dollar appreciates against the yen, we make even more money, right? Because we will get more Japanese yen for every dollar we invested in treasuries. And even with modest US dollar depreciation, we still earn money. But what would stink is when the yield on your US dollar asset goes down, your financing costs in Japanese yen goes up, and the currency would sharply move against you.
Might run into some chop.
Chop? We could fucking handle chop, right?
Maybe a few broken dishes.
A few broken dishes?
So the yen carry trade has been quite popular with both retail investors and hedge funds, but how large is it? Actually, no one knows. Could be as low as 350 billion or multiple of trillions. But according to most analysts, the yen carry trade was quite crowded going into July. Let's get back to our timeline. So now, since inflation has started to converge to Bank of Japan's target, the BOJ has decided that it's time to raise interest rates, something that hasn't happened since the global financial crisis. Meanwhile, in the US, inflation has come down, so the Federal Reserve is actually expected to cut rates as early as September. And all this seems to have had an impact on the currency, the Japanese Japanese yen has appreciated against the US dollar since July. So let's see how a yen carry trade implemented at the start of July would have performed. To invest 100,000 US dollars on 1st of July, we would need more than 16 million Japanese yen. Now, instead of putting our US dollar amount into treasuries, we will invest it in the Nasdaq. To finance our position, we will borrow 80% of the amount. And again, we will simplify and assume that we pay 0% interest. By the start of August, the Nasdaq is down more than 6%. Converting back our US dollar investment into Japanese yen, our carry with 5 times leverage is negative 67%. And holding this position further until the US close on August 5th, we would have been even worse off, since the Nasdaq kept falling and the yen kept appreciating further. So again, this is just a simplified example. It's just to illustrate that for these carry trades, when the currency moves against you and with the use of leverage, things can go bad very fast.
My God, okay, it's happening.
And in these situations, when traders are exiting this trade, they would need to sell their risky assets in order to raise cash. In our example, we would unwind our position by selling the US dollar risky asset, convert the US dollars back into Japanese yen in order to cover our short yen exposure. If many market participants starts to unwind these FX carry trades simultaneously,
Everyone for himself. Okay, let's go. Let's go. Get out of my way.
kind of creates a vicious cycle where risky assets keep being sold at fire sales, pushing down prices even further, and Japanese yen being bought up, worsening the market-to-market value of the FX carry position further. Goldman Sachs saw one of the largest reduction in leverage for the past 10 years for its hedge fund clients. And since the cross-border lending in Japanese yen was so large, in case counterparties that had borrowed in yen were to fail, Japanese banks would be left with potential losses. And this could explain some of the sell-off we saw in Japanese banks as well. In times of market stress, gold is usually seen as a safe haven asset, but in a dash for cash, even gold takes a hit because you're selling everything to raise cash. The Nikkei has been quite correlated to the Japanese yen. An appreciation in the Japanese yen is usually coupled by falls in the Nikkei. One explanation is that Japan has a lot of export companies. So if these companies have a lot of revenues denominated in other currencies overseas that are appreciating against the yen, your earnings that are denominated in yen will get a boost just from the currency move. And the same holds true for large Japanese banks who has lots of overseas investments. So the Nikkei is more sensitive to movements in its domestic currency compared to most other markets. Making matters worse, after a good run of stock market returns for the year, many were very leveraged. Also, investors had been encouraged to put more money into stocks after the government announced new tax-free accounts this year. So in a falling market, many of these investors might have had to liquidate some of their positions because of the use of leverage, exaggerating the moves even further. So to wrap up, all the negative sentiments stemming from worse than expected US macro data and mixed results in the earnings, after a long period of low volatility and steady gains, became the perfect storm for a large correction. And in Japan, the appreciation of the yen and leveraged crowded bets amplified losses even further. Now, it's important to note that explaining the day-to-day movements of the markets is usually just a guessing game. Sometimes those guesses can be more informed than other times. But when you hear reporters saying that the S&P 500 went down X% because this and that, usually they're just naming things that happened during that day. And as you know, there's a difference between correlation, two events happening at the same time, and causation. Event A caused event B to happen. I mention this because financial media and people in general, me included, tend to want to find simple explanations for something as complex as equity markets.
They know nothing!
So it is hard and sometimes actually wrong to just boil it down to a few events. But in my opinion, based on what I've read about this, it seems to me that the unwind, or actually just the belief that people would unwind this Japanese yen carry trade, had an amplifying effect to the movements in risky assets. But to what degree this had an impact, that is of course up to debate. And the market correction told us more about how investors were positioned going in than what the market actually believes about fundamentals or views of the economy. Okay, that's it. Thanks for watching. Please make sure to leave a like and subscribe if you haven't already done so, and I'll see you in the next video.